In the autumn of 1929, while Wall Street celebrated what seemed like temporary market turbulence, Jesse Livermore quietly positioned himself for history's greatest short sale. The former bucket shop runner wasn't reacting to headlines or following crowd sentiment. Instead, he was reading what he called the tape's secret language, identifying subtle patterns that had been whispering of the coming collapse for months, while others chased the final euphoric rallies. By Black Tuesday, this systematic approach had generated a $100 million fortune. But the real lesson wasn't in the profit, it was in the method. Livermore had discovered that breakouts don't appear suddenly. They announce themselves through 5 specific early warning signs that most traders completely miss. Here lies the central paradox of profitable speculation. By the time a breakout becomes obvious to everyone, the real opportunity has already passed. Most traders chase the excitement of stocks surging through resistance on heavy volume, buying into the very enthusiasm that smart money uses as their exit liquidity. Livermore reversed this impulse entirely. He taught himself to respect the build, up the subtle shift in control from sellers to buyers, training his eye to spot preparation weeks before confirmation arrived. This wasn't mystical intuition but observable, repeatable patterns that appeared in price and volume behavior long before the obvious breakout bar captured everyone's attention. The 5 early signs formed a systematic framework that transformed random market movements into predictable probabilities. Each signal built upon the previous one, creating a cascade of evidence that supply was weakening and institutional accumulation was underway. Livermore understood that significant moves required proportional preparation periods, and he learned to identify these staging areas through disciplined observation and precise criteria. The first sign, what he called the refusal pattern, centered on stubborn strength in the face of broader market weakness. Future leaders would make higher lows while indices trended downward, displaying defiant resilience that indicated quiet institutional buying. Livermore looked for stocks hitting 3 to 5 day relative strength highs while the market lagged, pullbacks that found support at rising 20-day averages, and down days that closed in upper portions of their ranges with below-average volume. This wasn't merely relative strength, it was evidence of supply absorption against the tide of selling pressure. The second signal, the coiling spring, appeared as volatility compression near prior highs. Livermore recognized that large advances needed substantial causes, periods where available shares transferred from weak hands to strong ones. This manifested as tight consolidations lasting 6 to 12 weeks, with daily closes clustering within narrow ranges and average true range contracting 30 to 50% from prior swings. When prices stagnated near highs despite low volatility, it meant few sellers remained at those levels, creating powerful preconditions for explosive moves upward. The third indicator, the accumulation footprint, revealed itself through sophisticated volume analysis. Livermore tracked asymmetric patterns where up days consistently showed expanding volume, while down days exhibited contracting volume, seeking 2-to-1 ratios favoring accumulation over 20-session windows. He also watched for dry-up signals, at least 3 pullback sessions with volume at 70% or less of the 20-day average, combined with closes in upper halves of daily ranges. This effort versus result analysis distinguished genuine institutional positioning from retail enthusiasm. The fourth sign examined catalyst response, focusing not on news itself but how stocks absorbed information. Livermore favored positive surprises that gapped stocks up 4 to 8%. Then held above mid-gap levels for several sessions while building supportive shelves. Even more telling were up on bad news scenarios where bearish headlines failed to drive prices down, indicating underlying strength that overwhelmed negative sentiment. The market's verdict on catalysts revealed the true balance of supply and demand. The fifth and most crucial signal identified the pivotal point where accumulated preparation transformed into explosive execution. This wasn't merely a price level but a kinetic event. Decisive thrusts through resistance with volume 40 to 100% above average, following periods of tight consolidation or failed undercuts. Livermore bought slightly through these pivots, placing stops just below them, understanding that failure to hold invalidated the entire setup. He also sought cluster confirmation, where multiple industry leaders pivoted simultaneously, indicating broader market alignment. These 5 early breakout signs, when properly aligned, offered what Livermore called the tape reader's edge, the ability to hear tomorrow's music while others danced to yesterday's tune. The key was patience combined with precision, waiting for the setup to mature completely before taking action, then executing with absolute discipline when the pivotal moment arrived. The morning of the 15th of March 1901 found Jesse Livermore studying the ticker tape with unusual intensity as Union Pacific refused to follow the broader market's decline, displaying what would become his first systematic early breakout signal. While railroad stocks surrendered ground to selling pressure across the board, Union Pacific held firm, closing each session in the upper third of its daily range, despite the sector's obvious weakness. This stubborn display of strength wasn't random market noise. It was the tape's secret language, revealing that sophisticated money was quietly building positions ahead of a major advance. Livermore had observed this phenomenon during his bucket shop days, but it took years of systematic study to understand that stocks, displaying such defiant resilience, were telegraphing their intentions weeks before the obvious breakout captured everyone else's attention. The refusal pattern, as Livermore termed it, centered on a simple yet powerful contradiction. Future market leaders consistently made higher lows while indices made lower lows, recovered quickly from any dips, and closed near their daily highs even when broader sentiment turned negative. This wasn't merely relative strength, it was evidence of institutional accumulation, creating artificial support levels that became visible through systematic observation. Large operators couldn't build substantial positions without leaving footprints in price and volume behavior, and those footprints appeared as stubborn strength during periods when stocks should have been declining with the market. Livermore developed specific criteria that separated meaningful signals from false positives, creating a mechanical framework that removed emotion from identification. First, he looked for relative strength lines hitting 3 to 5 day highs while the broader market or sector lagged behind, indicating buying interest that overwhelmed available selling pressure. Second, he examined pullback behavior, seeking stocks that consistently found support at rising 20-day moving averages, rather than breaking down through obvious support levels. Third, he analyzed the character of down days themselves, favoring stocks that closed in the upper portions of their ranges with below average volume when the market showed weakness. He quantified this through rolling 20-session windows, counting strong versus weak closes relative to daily ranges and seeking at least a 12 to 8 bias toward upper range closes, while requiring pullback volume to run under the 20-day average by 15 to 30%. The psychological mechanism behind refusal patterns revealed the invisible hand of institutional accumulation at work. When large operators decided to build positions, they worked orders patiently, absorbing available supply whenever it appeared, rather than placing massive market orders that would drive prices against themselves. This created the artificial support that manifested as stubborn strength during periods when stocks should have been following the market's weakness. The more pronounced this refusal to decline, the more likely it was that significant accumulation was underway, with weak holders selling every dip while accumulators provided consistent bids just beneath recent lows. The Union Pacific situation in 1901 demonstrated these principles perfectly. While other railroad stocks declined 3 to 5% during broader market sell-offs, Union Pacific held within narrow ranges, making marginal new highs on several sessions and recovering quickly on the few days it did decline. More importantly, it closed near its highs on volume that was notably lighter than the selling pressure affecting its peers, creating weekly bars that showed consistent higher lows and higher highs, even as the railroad sector formed lower highs and lower lows. This divergence in weekly structure provided confirmation that daily observations weren't short-term noise, but part of a sustained accumulation campaign building momentum for the explosive 40% advance that followed in subsequent months. However, Livermore learned through experience that not all apparent strength qualified as genuine refusal patterns, developing guardrails to avoid costly traps. stocks could appear strong simply because their peers were weaker, creating false relative strength in declining sectors that lacked true underlying demand. He required sector confirmation, insisting that genuine refusal patterns occur within industries that were either stable or showing their own signs of strength. Additionally, he avoided V-shaped bounces that hadn't properly digested prior advances, recognizing that healthy bases required time to transfer shares from weak hands to strong ones through gradual, repeatable displays of stubborn strength, rather than dramatic snapbacks that often belonged to traders recycling shares rather than institutions planting flags. The real power of the refusal pattern lay in its ability to reveal institutional conviction before it became obvious to the crowd. When selling pressure mounted, and most stocks naturally followed the path of least resistance downward, those under active accumulation would display what Livermore recognized as the market's way of voting: effort without result on the downside, result without excessive effort on the upside. This asymmetry became his first early warning system, teaching him to mark the outliers that refused obedience to broader market weakness, positioning himself ahead of major moves rather than chasing them after they became visible to everyone else, setting the stage for his second crucial signal, where time itself would speak through the gradual tightening of trading ranges. By the spring of 1916, Jesse Livermore had mastered reading stubborn strength in individual stocks. But his greatest breakthrough came while studying Bethlehem Steel's peculiar behavior near its previous highs, where he discovered his second early breakout signal during what would become a legendary $2 million campaign. After advancing from $35 to $65, the steel giant entered a 12-week consolidation that initially appeared unremarkable to most observers, with each session's high to low spread contracting, while price held stubbornly in the upper third of its base. This wasn't the random sideways drift that characterized most consolidations, but systematic compression of volatility that indicated supply and demand reaching equilibrium at elevated levels, creating what he recognized as energy building for explosive moves. The coiling spring pattern emerged when stocks formed shallow, tight consolidations near prior highs, displaying what Livermore understood as supply absorption rather than distribution. Unlike obvious head and shoulders or double-top formations that warned of impending weakness, these compressed ranges suggested that sellers were becoming exhausted, while buyers remained patient but persistent. Livermore developed specific criteria for identifying genuine coiling springs, requiring 3 to 5 sessions of closes within 0.5% to 1% of each other, weekly bars showing progressively lower highs and lows, while price held in the upper third of the overall base, and average true range contracting 30 to 50% from prior swing highs. This volatility compression had to occur near resistance levels, rather than in the middle of ranges, indicating that supply was drying up precisely where it should have been most abundant. Time became Livermore's crucial anchor for distinguishing productive coiling from mere stagnation, as he learned that meaningful bases required 6 to 12 weeks of development, with at least 2 distinct episodes of volatility contraction. The first compression often represented initial testing of overhead supply, while the second indicated that available shares had been largely absorbed and the stock was ready for its next advance. During these periods, he watched vigilantly for distribution, weeks down weeks, with volume exceeding the prior 3 sessions, which would invalidate the pattern by suggesting that large holders were using any strength to liquidate positions rather than accumulate them. He insisted on bases finishing tight in their upper third rather than sagging into middle ranges, because mid-range compression indicated indecision rather than the supply absorption that preceded major advances. The psychological dynamics behind coiling springs revealed the invisible battle between institutional accumulation and retail impatience that fascinated Livermore throughout his career. As ranges tightened near resistance levels, weak holders grew frustrated with the lack of progress and began selling their positions to more patient operators who understood that such compression indicated supply exhaustion rather than demand weakness. The tighter the coil became, the more likely it was that available floating supply had been absorbed by strong hands willing to wait for the eventual breakout, creating the transfer of shares from impatient sellers to patient buyers that generated energy necessary for explosive moves once overhead resistance finally gave way. Bethlehem Steel's behavior during summer 1916 perfectly illustrated these principles in systematic action. The first 6 weeks of consolidation showed normal base, building behavior with ranges averaging 3 to 4 points per session. But weeks 7 through 10 displayed the telltale coiling characteristics Livermore had learned to recognize. Daily ranges contracted to 1 to 2 points, while closes clustered between $62 and $64, creating weekly bars with progressively smaller bodies, despite holding near the top of the overall base. Volume during this compression phase averaged 20 to 30% below the preceding month's levels. Yet any minor dips found immediate support with closes consistently in upper halves of daily ranges, indicating that patient accumulation was overpowering any remaining selling pressure. However, Livermore learned to distinguish productive tightness from dangerous stagnation through careful observation of volume patterns and range characteristics, developing guardrails that protected him from costly mistakes. He avoided obvious patterns that invited shakeouts, recognizing that the most powerful springs coiled quietly without drawing attention from the crowd. V-shaped rebounds that raced back to highs without pausing carried trapped supply, eager to sell into the next advance, having failed to spend the lateral time needed to neutralize overhead resistance. Wide and loose bases with big percentage swings on heavy volume told different stories entirely: distribution rather than preparation, while patterns that became too obvious to every trader and columnist invited engineered shakeouts designed to harvest stops before real moves began. When Bethlehem Steel finally thrust through $65 on volume, exceeding the prior month's average by 80%, Livermore recognized the kinetic moment when stored energy transformed into explosive movement, validating his systematic approach to identifying volatility compression as predictor of major moves. The subsequent advance to $95 over 6 months confirmed that coiling springs, when properly identified and patiently awaited, offered reliable early warning systems for significant breakouts. But the spring was only part of the story, as Livermore needed confirmation that someone was actually winding it through accumulation footprints that appeared in volume patterns most traders completely overlooked. The autumn of 1919 found Jesse Livermore hunched over detailed volume sheets in his private office, tracking an extraordinary pattern in Cuban-American sugar that would crystallize his third early breakout signal and generate one of his most profitable commodity campaigns. While the sugar giant consolidated near its highs following a sharp advance from 8 to 14 cents per pound, casual observers saw typical sideways action. But Livermore's meticulous analysis revealed something far more significant. Up days consistently showed expanding volume, while down days exhibited contracting volume, creating what he recognized as institutional accumulation footprints. This asymmetric relationship between price direction and trading activity wasn't random market behavior, but systematic evidence that large operators were building positions, absorbing every share that weak holders offered during minor declines, while stepping aside during advances to avoid driving prices against themselves. The accumulation footprint emerged through Livermore's sophisticated understanding that volume represented effort, while price movement represented result, and the relationship between these two factors revealed the market's true intentions behind surface price action. When stocks advanced on heavy volume but declined on light volume over sustained periods, it indicated that demand was overwhelming supply at current levels, with institutional buyers providing consistent bids below the market while avoiding aggressive purchasing that would alert competitors to their campaigns. Livermore developed a systematic framework for measuring this effort versus result relationship, tracking rolling 20-session windows where he counted plus volume days, up closes with above, average volume, versus minus volume days, down closes with above, average volume, seeking ratios of at least 2 to 1 favoring accumulation patterns that couldn't be sustained through random trading alone. The dry-up signal became Livermore's most reliable confirmation of institutional positioning, appearing when pullbacks occurred on dramatically reduced volume while maintaining healthy closes relative to daily ranges. He required at least 3 consecutive pullback sessions with volume at 70% or less of the 20-day average, combined with closes in the upper halves of daily ranges, indicating that selling pressure was evaporating while buyers remained patient but present beneath the market. This volume behavior told the story of supply exhaustion more clearly than any price pattern, because it revealed that fewer shares were available for sale at current levels, and those that did trade found immediate absorption from waiting buyers who understood the stock's longer-term trajectory and were willing to accumulate positions gradually rather than chase momentum. The psychological mechanism behind accumulation footprints revealed the invisible choreography between institutional patience and retail impatience that fascinated Livermore throughout his career. Large operators seeking substantial positions without moving markets against themselves would patiently absorb shares on any dip, then allow prices to drift higher on lighter volume, knowing that few sellers remained at those levels. When advances finally started, they would often step in with additional buying, creating higher volume on up days. But when stocks inevitably pulled back, their buying would recede, allowing prices to dip slightly on much lower volume while they waited for the next opportunity to accumulate shares from impatient holders who couldn't tolerate the sideways action. Cuban American Sugar's volume footprint during late 1919 demonstrated these principles with textbook precision, as Livermore's detailed records revealed the systematic accumulation campaign that preceded the explosive advance to 22 cents. During the 12-week consolidation between 13 and 15 cents, up days averaged volume 43% above the 20-day. Meanwhile, down days averaged 27% below it, creating the asymmetric signature that indicated institutional buying rather than random fluctuation. More importantly, 3 separate pullback episodes showed classic dry-up characteristics, with volume falling to 50 to 60% of normal levels, while closes held consistently in the upper 70% of daily ranges, suggesting that available supply was being quietly absorbed by patient accumulators rather than dumped by panicked sellers seeking immediate liquidity. Post-shakeout accumulation provided another crucial variation of the volume footprint that Livermore learned to recognize and exploit throughout his systematic approach to market analysis. When stocks undercut obvious support levels on heavy volume, but quickly reversed with minimal net downside progress, it often indicated that selling climaxes had transferred shares from weak hands to strong ones at favorable prices below fair value. These undercut reversals required specific volume characteristics to qualify as accumulation, rather than mere technical bounces. The selling day needed volume at least 50% above average. The reversal day required above average volume, with a close in the upper third of the range, and subsequent sessions had to show dry-up characteristics that confirmed the shakeout had achieved its purpose of transferring floating supply to institutional buyers at discounted prices. However, Livermore developed strict criteria for distinguishing genuine accumulation from emotional trading that created high volume but poor outcomes, learning through expensive experience that not all volume expansion indicated institutional positioning or sustainable momentum. News-driven spikes often generated massive volume, but sloppy price ranges with poor closes, representing retail enthusiasm rather than professional accumulation, and typically exhausting themselves within days rather than building sustainable foundations for major advances. He avoided volume patterns that showed equal expansion on both up and down days, recognizing these as churning rather than directional accumulation, and insisted on volume leadership during advances rather than declines. Because true accumulation meant buying strength systematically rather than catching falling knives emotionally, setting the stage for his fourth crucial signal, where catalyst response would reveal whether accumulation translated into sustainable momentum when news finally tested the market's true intentions. The morning of the 28th of October 1925 brought Jesse Livermore face to face with his most sophisticated market insight when Radio Corporation of America gapped up 7% on earnings that exceeded expectations by 35%, then held above the gap's midpoint for 5 consecutive sessions while building what he recognized as a supportive shelf. Most traders celebrated the earnings surprise itself, but Livermore understood that the stock's reaction to this catalyst revealed far more about institutional intentions than the news contained, crystallizing his fourth early breakout signal through systematic analysis of how markets absorbed information rather than what that information actually said. The gap itself mattered less than Radio Corporation's ability to hold its gains, digest the advance on reduced volume, and build a platform for the next leg higher, demonstrating that underlying accumulation was strong enough to support higher prices even after good news had been fully recognized and initially acted upon by the broader market. The catalyst response signal emerged from Livermore's recognition that news itself was merely a test of underlying supply and demand dynamics, with the market's verdict on catalysts revealing the true balance of institutional positioning that had been building beneath the surface during previous accumulation periods. He developed specific criteria for evaluating both catalyst quality and market response, focusing on positive surprises that gapped stocks 4 to 8% higher from the upper third of established bases, then held above mid-gap levels for 3 to 5 sessions, while volume normalized and price action remained constructive rather than erratic. The earnings or revenue surprise needed to exceed 20% of expectations with acceleration in year-over-year growth metrics. But more importantly, the first post-news close had to occur in the top 20% of the daily range, indicating that buyers were stepping in aggressively to support the advance rather than sellers using the enthusiasm as an opportunity to distribute shares to retail investors chasing momentum. Shelf-building requirements became crucial for distinguishing sustainable catalyst responses from short-term emotional reactions that would quickly reverse once initial enthusiasm subsided and reality set in. Livermore insisted on pullback volume running at 80% or less of the 20-day average during post-catalyst consolidation periods, combined with relative strength lines hitting new highs before price confirmation, indicating that institutional support remained intact even as retail interest temporarily waned following the initial excitement. The shelf itself needed to form in the upper third of the post-catalyst range, with at least 3 sessions of closes within 2% of each other, creating a platform that could support the next advance when additional buying interest emerged from either institutional sources or momentum followers attracted by the obvious display of strength and conviction. Even more revealing were the up-on, bad news scenarios that became Livermore's favorite catalyst responses, where bearish headlines failed to drive prices down and instead created buying opportunities for those who understood that underlying strength could overwhelm negative sentiment when institutional accumulation was sufficiently advanced and supply had been properly absorbed. In his wheat trading campaigns, he recorded harvest forecasts interpreted as bearish by the crowd, yet contracts closed higher on above average volume, quiet declarations that demand was absorbing everything, thrown at it regardless of surface level negative interpretations. These situations occurred when stocks opened lower on disappointing news, but quickly reversed to close in upper portions of their ranges, or when negative headlines that should have caused significant declines instead resulted in minor pullbacks that found immediate support at recent consolidation levels, indicating that floating supply had been largely absorbed and weak holders had already been eliminated during previous shakeout periods. The psychological mechanism behind catalyst response revealed how sophisticated operators used news events as cover for position adjustments, while retail traders focused on headlines rather than underlying market dynamics and institutional behavior patterns. When good news emerged, institutions that had been accumulating positions during quiet periods would often step aside temporarily, allowing retail enthusiasm to drive initial price advances before resuming their systematic buying programs once emotional responses subsided and shares became available again at reasonable prices below the initial gap levels. Conversely, bad news often provided opportunities for additional accumulation as weak holders panicked and offered shares below fair value to buyers who understood that temporary negative developments rarely changed long-term business fundamentals for companies under active institutional sponsorship and systematic accumulation campaigns. However, Livermore learned to avoid several failure modes that could turn positive catalyst responses into costly mistakes, developing strict guardrails that protected him from the enthusiasm that often accompanied obvious strength and apparent easy profits, chasing extended gaps without proper base. Building violated his systematic approach, because stocks that advanced too far too fast on news typically needed significant consolidation periods before sustainable advances could resume without creating dangerous overhead supply. Gaps that filled below their midpoints within 48 hours often indicated distribution disguised as strength, where large holders used retail enthusiasm to liquidate positions rather than build them systematically over time. Most importantly, he avoided news-driven moves that lacked the prior accumulation footprints, coiling spring characteristics, and refusal patterns that indicated genuine institutional preparation. Because catalyst responses without proper foundations typically resulted in brief advances followed by disappointing reversals, trapped momentum buyers who focused on headlines rather than the systematic market preparation that preceded truly sustainable breakouts, setting the stage for his fifth and most crucial indicator that determined the precise moment when accumulated preparation would transform into explosive execution. The autumn of 1922 found Jesse Livermore positioned at his most sophisticated understanding of market timing, as 4 months of systematic preparation in December wheat futures converged into what he recognized as the pivotal point where accumulated energy would transform into explosive execution. The grain had displayed every early signal in perfect sequence: stubborn strength during broad commodity weakness, volatility compression near contract highs, asymmetric volume patterns indicating institutional accumulation, and constructive response to harvest reports that should have pressured prices, but instead found immediate buying support. Now, as December wheat thrust decisively through its previous high of $1.38 on volume, exceeding the prior month's average by 85%, Livermore understood that supply had finally capitulated completely, creating what he called the line of least resistance, where months of patient positioning transformed into kinetic movement that would generate over $300,000 in profits during the subsequent advance to $1.72. The pivotal point represented far more than a simple price breakout that attracted momentum followers seeking obvious opportunities after moves had already begun and risk-reward ratios had deteriorated significantly. It was a kinetic event where the accumulated weight of institutional positioning overwhelmed remaining supply at precisely the moment when resistance transformed into support, creating the explosive moves that separated systematic speculation from random gambling throughout Livermore's legendary career. He identified these moments through specific criteria that eliminated false breakouts and emotional decision, making recent undercuts or shakeouts that failed to gain downside traction, despite obvious selling pressure, quick reclaims forming tight shelves just below prior highs with volume patterns favoring accumulation over distribution, and decisive thrusts through resistance, accompanied by volume expansion of 40 to 100% above recent averages, indicating that institutional buying was finally overwhelming the last vestiges of available supply at current price levels, while weak holders capitulated completely. His execution framework eliminated the guesswork that destroyed most traders when obvious opportunities finally presented themselves after months of patient observation and systematic preparation throughout the complete signal development cycle. Livermore bought slightly through the pivot rather than waiting for pullbacks, understanding that genuine pivotal points rarely offered second chances at favorable prices because the supply that had been available during preparation phases had been systematically absorbed by patient accumulators who understood the longer-term trajectory and were willing to pay slightly higher prices to secure positions. He placed stops just below the pivot point or the shelf that preceded it, typically 5 to 7% maximum, because failure to hold these levels invalidated the entire setup by indicating that supply had not been properly absorbed and institutional support was insufficient to sustain higher prices against determined selling pressure from holders seeking to exit positions at favorable levels. Cluster confirmation became crucial for distinguishing isolated breakouts from genuine market-wide shifts that could sustain extended advances across multiple securities and sectors simultaneously. Livermore sought situations where multiple industry leaders pivoted within days of each other, while major indices remained above key moving averages, because such alignment indicated broad institutional commitment rather than narrow speculation that typically exhausted itself quickly when broader market conditions failed to support sustained strength. The 1928 advance demonstrated these principles repeatedly as leading stocks in automobiles, steel, and chemicals broke out from well-formed bases within weeks of each other, creating the synchronized strength that characterized major bull market phases and distinguished them from isolated rallies that failed when broader participation declined and leadership narrowed to unsustainable levels. The wheat campaign of 1922 demonstrated these principles with mathematical precision as Livermore's systematic approach converted months of preparation into explosive profits through disciplined execution at optimal timing. The initial thrust through $1.38 occurred on volume 200% above the 20-day average, with December wheat closing at $1.40, 1 cent in the upper 90% of that session's range, confirming that buying interest was overwhelming available supply rather than simply creating temporary momentum that would quickly exhaust itself when institutional support withdrew. More importantly, the following sessions showed classic post-pivot behavior with minor pullbacks, finding immediate support just above the breakout level on dramatically reduced volume, indicating that the pivotal point had indeed transformed resistance into support, and floating supply had been largely eliminated at those price levels through the systematic accumulation that preceded the explosive advance. However, Livermore's strict failure criteria protected him from the overconfidence that often accompanied obvious success and apparent validation of systematic market analysis. He refused anticipatory entries inside established bases, regardless of how obvious eventual breakouts appeared, because premature positioning violated disciplined approach and often resulted in being shaken out during final testing phases that preceded genuine moves. Ignoring volume confirmation represented another critical failure mode, because breakouts without proper institutional participation typically indicated false moves rather than sustainable advances that could withstand inevitable selling pressure from profit takers and new short sellers attracted by obvious momentum. Most importantly, he immediately exited any position that quickly failed back into its base on heavy volume, understanding that such failures indicated his analysis had been incorrect and apparent accumulation had actually been distribution disguised as strength by sophisticated operators, demonstrating that even perfect signal alignment required disciplined execution and immediate exit when positions failed to perform as expected, setting the foundation for understanding how these 5 early breakout signs transformed random market speculation into systematic probability-based decision making that could be applied across different time periods and asset classes with mathematical consistency.